Hello, this is Mr. Smith, and this is Honors Economics. And today we'll be going over unit number 4, and this is the first lecture in that unit about the financial sector. And so we'll be talking about money and banking, specifically defining money, the way that we measure it, the function that banks have in our economy serving as financial intermediaries, and how banks create money. And money, of course, includes more than just the paper bills and coins that we have. It includes anything that acts as a store of value, a unit of account, or medium of exchange. And so going back in time, we can find a variety of objects that were used as money. For instance, seashells in places such as islands in the South Pacific were used as a form of money. So it is possible for different types of objects to be used as a medium of exchange. And what do I mean by medium of exchange? It acts as an intermediary, as an object that can be used between the buyer and the seller. So instead of exchanging, for instance, bread for milk, when everybody disagrees about the value and it leads to long sense of negotiations or haggling, that if a price is given based on the value of money, then that money can then be used to exchange these goods. And so it acts as an intermediary, as an in-between. And so it actually makes it more efficient. Often when we add a middleman, people think, oh, that must make it less functional. But actually money makes it a more efficient system than using bartering itself. So medium of exchange is one of the important functions of money. The second one is a store of value. So when we say store of value, it means holding on to the value, retaining its worth. And if we were just trading things, bartering, and so if there was a shoemaker trading shoes for bookkeeping by an accountant, she risks, of course, having her shoes go out of style, especially if she keeps them in a warehouse for future use. So shoes being used as commodity money, as a means of trading, wouldn't necessarily have a good store of value. And so that's why it's better that we have money instead of just trading items, because the items itself won't retain their value over time. Now, of course, even money, because of inflation, has changing value, but compared to other objects, it is much more efficient. And the third function of money would be unit of account, which, of course, is a system that we use to measure value. And so it's like a ruler. It's a tool that we use in order to compare values through a pricing system. One other function of money would be standard of deferred payment. This means that if money is usable to make purchases today of certain items, we must also be able to purchase those same items in the future with that money. And so that standard of deferred payment, the fact that we can do it in the future, is also another efficiency of money. And then there are also different types of money. Before we move on to that, there are the definitions, once again, of the different functions of money, if you want to pause that. But the different types of money include commodity money, representative money, and fiat money. Commodity money is when an actual item is used as money that also has value as itself. So if we were using seashells as money, it's because the seashells are valuable. They can also be used for jewelry or crafts. And then we also use them as money. Commodity-backed currencies, or representative money is another phrase for that, is when dollar bills or coins or other types of things have value because they're backed up by a commodity, like gold, for instance. And throughout the American history, gold and silver had backed the supply of money in the United States, although that's a complicated history because we often had state currencies, other institutions making currencies, and that we'll get into that a little bit later. But anyway, commodity money, representative money, also called commodity-backed money. And then the third type would be fiat money. And fiat money is, it itself basically doesn't have anything to back it up, and these For instance, the paper bills themselves, what could they possibly be used for? They could be shredded for confetti. They could be in a cold winter storm, be lighted on fire to provide warmth. But other than that, they don't have value by themselves. They only have value because they're declared to be the country's legal tender. And the Federal Reserve, when it orders currency from the Treasury, it limits the supply, and there is high demand. Many people, including in other countries, want to use the American dollar. And because of that, it has value. And that's the only reason why gold has value. There's a low supply of it. There's a lot of people that demand it because people like shiny things like squirrels and crows, and therefore it has a high value. So the same thing is true of the actual currency. You just need supply and demand. And so the only backing of our money is the universal faith and trust that the currency has value. So that, of course, creates the demand for it. So there could be a low supply, a tight supply, but if there was no demand at all, then it really wouldn't have any value. But there is high demand for the use of American dollars, not just by us, but also by others as well. So today we use fiat money, but this picture here is comparing the fiat money that we use today to an old commodity system that we had partially in the past. Until 1958, these dollar bills were issued, and if you look closely, you can see that it says silver certificate. And so that means that this is backed actually by silver. So that system doesn't exist anymore. We started getting rid of the gold standard in the 30s, and by the 70s, it was completely gone. And so we've used fiat money since back then, but definitely by 1958, we, for our regular currency, had been using fiat money. And then any connection to the gold standard was completely gotten rid of by the Nixon administration. But when we talk about money, of course, the money itself and the supply of it is dictated by the Federal Reserve, which is our central banking system. It's in charge of regulating and monitoring monetary policy and also the actual commercial banking system. It defines money according to its liquidity, so how easily it flows, like liquid water, throughout the economy. And so it divides up the money system into a few different categories. And you can see the first one there is called M1. And this is a narrow definition of the money supply that includes currency and checking accounts. So these have immediate or almost immediate liquidity. You can check or cash to even small businesses, and they're going to say, okay, and they're going to take it. You can spend it right away. So that includes M1. If you just want to include currency, that's actually called M0, but we don't want to go too much into depth here. M2 includes M1, but also includes things that have less liquidity, savings deposits, money market funds, and certificates of deposits, or CDs, that it might take some time to get some cash from. And so these include savings deposits, which are bank accounts that you cannot write a check from directly. They include money market funds, which pull together deposits of many individuals who want to invest in a safe way, such as short-term government bonds. And also CDs, or time deposits. The full name is certificate of deposit, which are accounts that a depositor is committed to leaving in the bank for a certain period of time, for a few months to a few years, in exchange for a higher interest rate. And if you do pull out money, of course, there's a penalty for that. So these have less liquidity. Money flows less easily than those that are just in M1. But M2 includes both. They include these new ones that I've introduced and also the M1 on top of that. So the M1 supply includes coins and currency and checkable deposits. And here are the definitions here if you'd like to pause that and write that down. Also traveler's checks. And M2 includes these different items that I've already mentioned, but you can go ahead and pause this once again and write down any of these definitions that you wish. Certificates of deposit are a good way to invest money. They have a higher interest rate than savings accounts, but once again, they last for several months to a few years. So your money is locked away unless you want to accept some type of penalty. But there you can see M1 in the smaller bubble, but it is included within the bigger bubble, M2. So M1 plus these additional items make up M2. And so there are other types of money, debit cards that comes directly from your checking account, credit card, which is a revolving type of loan that's short term, smart card, and that is for stores that stores a certain value of money on the card, and then one can use the card to make purchases. And you can buy those, for instance, at places like Giant Eagle. And then most money is in the form of bank accounts. So that's where we store most of our money. But that only exists as electronic records on computers. Banks don't keep all of the money. They loan out most of it. So banks provide the service of having these bank accounts. They also provide payment systems. So it helps us exchange goods and services because it allows you to have deferred payments over a period of time. They also provide or take care of transactional costs, the cost of finding a lender or borrower for the money. Because banks take care of all of this. They take the money from savers. They then have programming to allot the money to borrowers. And so we don't have to meet on the street, savers and borrowers, hey, will you loan me money? That doesn't have to happen. So the money from the savers is pooled. It then can be loaned out, and then interest is collected, sent back to the bank, and then some of that is sometimes shared with the savers. So banks bring savers and borrowers together. Banks lower transactional costs and act as a financial intermediary. So they're in between savers and borrowers, and they take care of all of the effort that has to go into the actual loaning of money, known as the transactional costs. And a financial intermediary, once again, is an institution that is in between savers and borrowers. And that could include not just banks, but credit unions, finance companies, financial advisors, insurance companies, all of those would qualify. But a general term that we can use is depository institution that accepts money deposits and then uses these to make loans. But here we can see a graph of that. Banks or other financial intermediaries would be in the middle here, savers, borrowers. Savers make deposits, and the bank loans out money. The borrowers repay the loan with interest, and then that money, of course, goes back to the savers in the form of withdrawals and interest that is paid on higher threshold checking accounts and savings accounts. So banks act as a middleman because they stand between the savers and borrowers. Savers put the money in the bank and receive interest payments and withdraw money. Borrowers receive the loans. And this is important because from a macroeconomic scale, small governments, businesses, and families can't make large purchases such as equipment, vehicles, housing, factories, storefronts. They can't make those purchases on their own, and so they need to borrow the money in order to do so. And so that helps pool the money of everyone, so that way those actors can then take that money and put it into capital. So when a bank operates, it has a balance sheet, an accounting tool that lists assets and liabilities. So things that are advantages, things that are disadvantages. This is an item of value that a firm or individual owns. So that is an asset. So if you have a car, that is an asset. Liability, any amount or debt that a firm or individual owes. If you have a loan for that car, though, the outstanding amount of money is a liability. The net worth is the excess of assets. So whenever we have a surplus of assets that is greater than the liability, that indicates our net worth. So obviously it's negative, it means we have more liabilities. And bank capital is a bank's net worth because they have to have all of their assets outlined and all of their liabilities, all of the money they have loaned out. Actually qualifies as an asset because that is something of value that they're going to get back, including the interest. The liabilities for a bank are the deposits. So when a bank customer deposits money into a checking account or a savings account or a certificate of deposit, banks view these as liabilities because they owe this money back to those people that put the money there. And so when they loan out 90% of it, the loans, the actual cash that's gone out, that is something they can count on getting it back. So it's an asset, but in terms of how much money that they've taken out of these people's accounts, or the money that these people put into the bank, that is the bank's liability. So this figure shows a hypothetical and simplified balance sheet for a safe and secure bank. And the T account is a balance sheet with two-column format, with a T shape formed by the vertical line down the middle and the horizontal under the column headings for assets and liabilities. And the assets of the firm are on the left and liabilities are on the right. So there you can see they have loans outstanding from this bank of $5 million. That counts as assets because that is money that they're going to get back. They've also have U.S. securities. So they've loaned money to the government by buying bonds usually, and so that's $4 million, and then they have $2 million in reserves on hand. Deposits, $10 million that people have put into the bank, that is their liability. So there we can see if we add up 5 and 4 is 9 and 2 is 11, and they have deposits of $10 million, so their net worth is $1 million. Reserves are funds the bank keeps on hand and that does not loan out or invest bonds. Usually that is helpfully determined by the Federal Reserve through setting what is called a reserve requirement or reserve ratio, where they say that you have to keep a certain amount of money in the bank, usually a certain percentage. Net worth of a bank is its total assets minus its total liabilities. For a financially healthy bank, the net worth will be positive. If a bank has a negative net worth and depositors try to withdraw their money, the bank would not be able to give all the depositors their money. And so if they came back, for instance, if this was a negative number, they're definitely not going to be able to cover it if there's a rush of people to come in to pull out their deposits. Potential problems for a bank is a high rate of loan defaults. What if all the people who have pulled out this $5 million can't repay it? That would be bad. Asset liability time mismatch is the ability for customers to withdraw bank's liabilities in the short term while customers repay its assets in the long term. So that's one of the problems, is that people can pull out their deposits right now, but they don't have to pay off their loans for 60 days for a short-term one, or maybe even 30 years in the case of a mortgage. So there are strategies to reduce risk, and this is also true for financial investments. Diversify, making loans or investments with a variety of firms to reduce the risk of being adversely affected by events at once, or a few firms. So sell some of the loans they make in the secondary loan market. So that's also possible. So that's something people aren't aware of. They get a loan from a bank, somebody else might actually control the loan, and hold a greater share of assets, government bonds or reserves in particular. So how a bank can create money? The banking system can create money through a process of making loans. In the T account balance sheet above, Singleton Bank is simply storing money for depositors and not making loans. And so it's collected $10 million in deposits, and it's also keeping all of it. So its reserve ratio is at 100%. They are keeping everything. It cannot earn any interest income. It cannot pay its depositors an interest rate. So that's the downside of doing something like that. Now, down here, by loaning $9 million, and so they're loaning out 90% and charging interest, it will be able to make interest payments to depositors. This alters Singleton Bank's balance sheet. It now has $1 million required 10% in reserves and a loan to Hanks Auto Supply of $10 million. So there you can see they have a total assets of $10 million, and the deposits are $10 million as well. So their net worth is still flatlined in this particular case. So Singleton Bank issues Hanks Auto Supply a cashier's check for $9 million. Hank deposits the loan in his regular checking account with First National Bank, so a different bank. So he puts his money, his deposit, into First National Bank, and so they have $9 million worth of liabilities, and they're keeping all of it at first, and so they have assets of $9 million. But that means the total amount of money in this imaginary situation, let's say these are the only people and the only banks that exist in the country, now there's $19 million. It started off with only 10, and there really only is 10 But on the balance sheets, there's a total of 9 million and 10 million, which is 19 million. So we've expanded the money supply by $9 million. First National Bank has to hold the same 10%, and they can lend out the rest. So they can loan out $8.1 million to Jack's Chevy dealership. So they have $90,000 in reserves. You're going to loan out $8.1 million. Jack's Chevy dealership deposits the loan in checking account at Second National. So the money supply just increased again by $8.1 million. So we have this original $10 million. We've added an additional 9, and now we have an additional $8.1 million. And so we are continuing to increase the amount of money in the system. Making loans that are then deposited into a demand deposit account increases the M1 money supply. This money creation is possible because there are multiple banks in the financial system. They're required to hold only a fractional reserve of their deposits. Loans end up deposited in other banks, which increase deposits and the money supply. If all the banks loan out their excess reserves, the money supply will expand. In a multi-bank system, institutions determine the amount of money the system can create by using the money multiplier. And the money multiplier formula is 1 divided by the reserve requirement, which in this case is 10%. By multiplying the money multiplier by the excess reserves, we can determine the total amount of M1 money supply created in the banking system. So the quantity of money in the economy is closely linked to the quantity of lending or credit. All the money in the economy except original reserves is a result of bank loans and redeposits. A bank can also choose to hold extra reserves above the required amount if they do so. Banks may decide to vary how much they hold in reserves for 2 reasons. Macroeconomic conditions, so contraction or that's drawn out like a recession, for instance, or government rules. In that case, they really don't have a choice. In a recession, banks are likely to hold a higher proportion of reserves because they're afraid that customers are less likely to repay loans or that some of them might come to withdraw more deposits. The Federal Reserve might also raise or lower the required reserve held by banks as a policy move to affect the quantity of money in the economy. Additionally, if people do not deposit cash, banks cannot recirculate the money in the form of loans. So if people are getting cash and they're paying bills or keeping the money at home, then that can cause additional issues.